Could you imagine turning 60 years old, looking retirement squarely in the face, and realizing you had only a paltry $5,000 to your name? For most, that thought alone triggers a cold, paralyzing dread. It's the kind of scenario that whispers, "It's too late, you missed your chance." We've all felt that anxious tug, that gnawing worry that we haven't saved enough, that the dream of a comfortable retirement is slipping further and further away with each passing year. The conventional wisdom, pounded into us from every financial pundit, is that you need $1 million or even $2 million just to scratch by. And if you're not there by 50, let alone 60, many believe the game is simply over. This isn't just a financial burden, it's an emotional one, a heavy blanket of regret and perceived failure that smothers hope. You might feel a sting of recognition right now, perhaps thinking about your own savings, your own age, and wondering if there's any path left for you. But what if I told you that all of that conventional wisdom, all of that fear, could be fundamentally challenged? What if one man, starting from that seemingly impossible position at 60 with just $5,000, didn't just survive, but thrived? What if he built a meaningful, income-generating retirement plan in just 5 short years, defying every expectation? Today, we're diving deep into the extraordinary journey of Detective, a man whose story isn't just an anecdote, it's a blueprint. Detective wasn't a financial guru, nor was he privy to some secret Wall Street algorithm. He was just a regular guy, a former mechanic who, through a series of unfortunate life events and some understandable financial missteps, found himself staring down the barrel of an impoverished retirement. At 60, Detective's balance sheet was bleak. After years of hard labor, raising a family, and navigating the ups and downs of life, his personal savings account reflected a stark reality: $5,000. That's it. To put that into perspective, if you were to simply withdraw that $5,000 over a 20-year retirement, you'd have precisely $250 per year, or about $20.83 per month. Imagine trying to live on that. It's not just inadequate, it's a terrifying prospect that forces a reevaluation of all future plans. This wasn't just a number on a statement for Detective. It represented the culmination of a lifetime of effort, now seemingly insufficient. The emotional toll was immense. The dreams of travel, of comfortable leisure, of even just basic security felt like distant mirages. He faced not just financial insecurity, but a profound sense of despair, feeling like he had run out of time and options. The clock was ticking louder than ever, mocking his lack of preparation. Yet, Detective possessed something more valuable than a bulging bank account: an unwavering refusal to accept defeat, and a meticulous analytical mind honed over decades of troubleshooting engines. He didn't have much money, but he had a burning desire for dignity in his golden years. This brings us to the pivotal question that Detective's story compels us to ask. Can a modest sum, even as little as $5,000, started this late in life, genuinely build a meaningful, sustainable income stream for retirement in just 5 years? Is it truly possible to generate passive income sufficient to make a material difference when you're already past what most consider the prime saving years? Many would scoff, dismissing it as fantasy or pure luck. They'd point to the power of compounding, which works best over decades, not mere years. They'd cite inflation, market volatility, and the ever-increasing cost of living as insurmountable obstacles for such a small starting capital. Conventional financial models would suggest that to generate even a modest $500 per month from investments using a conservative 4% withdrawal rate, you'd need a portfolio of $150,000. Detective was starting with less than 3.5% of that target. The math, on the surface, seemed utterly against him. However, Detective didn't follow the conventional playbook. He didn't chase speculative growth stocks or gamble on cryptocurrency. Instead, he meticulously crafted a counterintuitive dividend strategy, a rescue plan that leveraged specific, often overlooked aspects of the market. This wasn't a get-rich-quick scheme. It was a disciplined, data-driven approach designed to maximize income generation from day one, not just capital appreciation. He knew that for someone in his position, income was paramount. His goal wasn't to become a millionaire, but to create a reliable, growing stream of cash flow that could supplement his meager Social Security and provide a cushion of independence. This was a strategy born out of necessity, refined by diligent research, and executed with unwavering commitment. The stakes couldn't have been higher for Detective. Beyond the purely financial figures, he was fighting for his self-worth, his peace of mind, and his ability to live his final chapters with dignity. The psychological burden of feeling like a financial failure at 60 is immense, often leading to resignation and a loss of hope. Detective's journey isn't just about dollar signs, it's about resilience, about defying the narrative that tells us it's too late. His story offers a powerful beacon of hope for anyone feeling behind, for anyone who believes their window for a comfortable retirement is closed. It proves that with the right strategy, a focused mindset, and a willingness to learn, even the most daunting financial gaps can be bridged. We're about to unpack precisely how Detective transformed that initial $5,000 into a 5-year dividend retirement plan that delivered tangible results, turning despair into a surprising victory. Get ready to have your assumptions about late-stage investing completely redefined. As we promised, get ready to have your assumptions about late-stage investing completely redefined by Detective's remarkable journey. His story begins not with a windfall, but with a profound moment of clarity that shattered conventional wisdom, his aha moment. Detective, facing 60 with just $5,000 to his name, realized that the oft-repeated advice of diligently saving 10% of his income for 40 years was frankly an insult. For him, starting late meant traditional approaches were a guaranteed path to financial insecurity. He understood he needed a different kind of engine, one that could generate income quickly and consistently, even from a modest starting point. This is where the power of dividend investing entered his radar, not as a get-rich-quick scheme, but as a practical, income-focused solution for his unique predicament. He dove headfirst into understanding how companies pay shareholders, realizing this could be his personal income stream, a way to build a financial foundation that didn't solely rely on selling assets. It was a pivot from scarcity mentality to a strategic income-generating mindset. With his $5,000, he didn't blindly chase speculative stocks. Instead, he made a calculated foundational move. He strategically allocated his capital into high-quality, diversified dividend ETFs, focusing on immediate income generation combined with stability. His choices included established funds like Vanguard's VYM, Schwab's SCHD, and Spider's SPYD. These weren't chosen for explosive growth, but for their consistent history of paying and growing dividends. He knew that diversification across many companies and sectors within these ETFs would mitigate risk, a critical factor for anyone approaching retirement. His goal wasn't to hit a home run, but to build a reliable base-hit machine, steadily churning out income month after month, maximizing risk. Let's really dig into the fundamentals Detective embraced. First, he understood dividend yield, the annual dividend payment per share divided by the share price expressed as a percentage. For example, if an ETF costs $100 and pays $4 annually, its yield is 4%. His chosen ETFs collectively offered an average initial yield of approximately 4.5%. Second, he learned about dividend growth, recognizing that a company not only paying dividends but increasing them year after year was paramount to outpace inflation and boost his future income. Finally, and crucially, Detective embraced the power of dividend reinvestment plans, or DRIPs. This mechanism automatically uses the dividends received to buy more shares of the same ETF. It's a silent, powerful compounder. He understood that every dollar earned from dividends immediately put back to work meant he was buying more shares, which in turn would generate even more dividends, creating a snowball effect,
especially vital in these early stages. Now, let's get down to the brass
The stage for future growth. Detective understood that his initial $5,000 was just the starting pistol, not the entire race. He knew he couldn't simply rely on that initial sum to multiply itself fast enough. This led to the next crucial element of his plan, the power of consistent contribution. Despite his limited income, Detective committed to adding even small, consistent amounts to his dividend portfolio each month. He meticulously scoured his budget, cutting non-essentials, and took on part-time work, earning an extra $50 to $100 per month. Let's conservatively say he consistently added $75 per month. Over the first year, this adds an extra $900 to his initial capital. Combined with his initial $5,000 and assuming a 4.5% yield on these new contributions, he's adding another $40.50 in annual dividends just from these extra contributions. This might seem modest, but remember the DRIP. Each dollar of dividend income and every additional contribution was buying more shares. These new shares immediately began generating their own dividends. This consistent, disciplined habit dramatically accelerated the growth of his share count, which in turn compounded his dividend income much faster than if he had simply relied on the initial $5,000 alone. This small, consistent effort became the wind beneath his compounding wings. It's a testament to the fact that even small, consistent actions, when aligned with a powerful financial strategy, can create extraordinary momentum over time, especially for late-stage investors. Detective wasn't just saving, he was investing into an income-producing machine every single month, no matter how small the amount. All right, welcome back to Dividend Detective. If you're just joining us, we're diving deep into Detective's inspiring journey, a man who started his dividend retirement plan at 60 with just $5,000. In our last segment, we established how Detective wasn't just saving, but truly investing into an income-producing machine. Now we're about to explore the engine that fuels that machine, the crossover point, and how Detective accelerated towards it. This concept is a game changer, especially for late-stage investors, because it marks the precise moment your dividend income starts working harder than you do to grow your portfolio. Imagine this, a self-sustaining financial growth engine. That's the crossover point. It's when the annual dividend income your portfolio generates exceeds the new capital you contribute from your own pocket each year. At this critical juncture, your portfolio effectively becomes self-funding, buying more shares with its own earnings than you add with new savings. Think of it like a snowball rolling downhill, gathering speed and mass. Initially, you have to push it, but once it reaches a certain size and momentum, it just keeps growing on its own. For Detective, reaching this point wasn't just a financial milestone, it was a psychological triumph. Let's track Detective's mathematical progression. Starting with his initial $5,000 and consistent $100 monthly contributions, equating to $1,200 annually, his portfolio began its modest climb. By the end of year one, Detective had contributed $1,200, bringing his total capital, excluding market growth, just contributions, to $6,200. With a conservative average dividend yield of 4% across his holdings, his portfolio generated approximately $248 in dividend income. Reinvesting every single penny of that, his total portfolio value before market appreciation had grown to about $6,448. Not bad for just 12 months of disciplined effort, right? Now, entering year two, Detective's starting capital was $6,448. He diligently continued his $100 monthly contributions, adding another $1,200. But this is where Detective started to amplify his progress. He strategically added more capital beyond his regular contributions. Perhaps it was a small tax refund, a bonus from a part-time job, or even a modest inheritance he received. Let's assume Detective added an additional $2,000 in year two, boosting his total new capital for the year to $3,200. This lump sum, combined with his continuous contributions, brought his capital base to approximately $9,648 by the end of year two, before dividends. At that 4% yield, his annual dividend income jumped to roughly $386.
every dollar of that was reinvested, propelling his portfolio to over $10,034. The momentum was building. By the close of year 3, Detective maintained his $100 monthly contributions, adding another $1,200. He also found another opportunity to accelerate, adding an additional $3,000 from perhaps selling some unused assets or taking on a short-term side gig. His total new capital input for year 3 was $4,200. This aggressive injection of capital, building on his previous growth, brought his total investment capital to an impressive $14,234. His annual dividend income for year 3 then rose significantly to approximately $569, all reinvested. His portfolio now stood at roughly $14,803, almost tripling his initial $5,000 in just 3 years, thanks to consistent saving, smart reinvestment, and strategic capital injections. But Detective wasn't just blindly chasing yield. He meticulously evolved his portfolio strategy to mitigate risk and achieve a balance of yield and growth. Early on, he likely started with broad market dividend ETFs like VYM, the Vanguard High Dividend Yield ETF. VYM provides exposure to a wide array of high-yielding U.S. companies, offering excellent diversification and reducing single stock risk. As his confidence grew and capital accumulated, he would have strategically integrated ETFs like SCHD, the Schwab U.S. Dividend Equity ETF. SCHD is a powerful choice for dividend growth investors because it focuses on companies with a history of consistent dividend payments and strong financial health, offering both a solid yield and the potential for capital appreciation. By combining a broad market high-yield fund like VYM with a dividend growth-focused fund like SCHD, Detective achieved a robust portfolio. He gained exposure to diverse sectors, benefited from companies consistently increasing their payouts, and maintained critical diversification to protect against market volatility. This thoughtful diversification was essential for a late-stage investor. The true magic, however, wasn't just in the numbers, it was in the psychological momentum. Seeing his dividend income grow from a few dollars to tens, then hundreds, provided tangible proof that his plan was working. Those quarterly or monthly payouts landing in his account, automatically buying more shares, created an incredibly powerful feedback loop. It transformed his financial anxiety into excitement and reinforced his discipline. This emotional fuel was invaluable, motivating him to find those extra $2,000 or $3,000 injections, recognizing how dramatically they accelerated his timeline towards that transformative crossover point. Detective wasn't just investing, he was witnessing his future being built one dividend payment at a time. The initial $5,000 was merely the spark, but the consistent reinvestment, strategic capital additions, and psychological boost of growing dividend income were the accelerants that brought him closer to that transformative crossover point. Detective was proving that even starting late, you could build extraordinary momentum. Detective, at 65, began a new chapter 5 years after his initial $5,000 investment. His capital, combined with consistent $500 monthly contributions and reinvested dividends, created something remarkable. His portfolio, small, now commanded an impressive $98,340. This represented nearly a 20x growth on his initial capital, a testament to his commitment. Crucially, his average monthly dividend income soared from negligible amounts to a substantial $375. This income wasn't static, it was growing, providing tangible, predictable income. While $375 isn't a king's rams, it covered Detective's essential utilities, groceries, and allowed modest treats, altering his financial reality without touching capital. He transformed a modest start into a robust, reliable income stream, proving consistent action pays off immensely. Detective redefines retirement. He didn't seek luxury, his aspiration was financial independence. He needed supplemental income for non-negotiable monthly expenses, buffering rising costs and uncertainty. Average retired utility and grocery costs typically run $400 to $600 monthly. Detective covered at least 60 to 70% of these crucial expenses without touching his principal. This reduced pension reliance, giving breathing room, reducing stress, and granting choice. He could pursue hobbies, spend more time with family, or simply enjoy tranquility without constant bill worries. This wasn't luxury, this was liberation, achieved through smart, consistent financial planning, a true victory.
Vital and consistent contribution amount. Can you commit $100 to $200 monthly? Even $50 helps. Budget review often uncovers redirectable subscriptions or small luxuries. Next, research and select your dividend ETFs. Don't be overwhelmed. Start with broad market, low-cost dividend growth ETFs. Look for proven track records, diversified holdings, and yields aligning with your income goals. Consistency beats complexity. Our channel has videos on specific ETFs. Third, automate your investments. Set up automatic transfers from your checking account to your brokerage. Out of sight, out of mind, continuously working. This removes emotion and ensures discipline. Take that first step. Open a brokerage account, fund it, and buy your first dividend ETF today. Detective's story is your blueprint for financial freedom. Retirement isn't a pipe dream, even if you feel behind. If Detective transformed $5,000 into almost $100,000 and $400 monthly income in 5 years, imagine your potential. Knowledge and action start the journey. For more in-depth strategies, step-by-step portfolio builds, demystifying complex dividend investing, subscribe to Dividend Detectives now by clicking below. To meticulously track your own progress like Detective, we've created a free downloadable dividend tracker spreadsheet. The link's in the description. It's invaluable for visualizing income growth and motivation. Don't walk this path alone. Join our vibrant and supportive community via our Discord server link. There, ask questions, share your journey, learn from thousands. Detective guides you. Click subscribe, grab your tracker, and let's build your dividend dream together.